Revolut just announced plans for an initial public offering that would value the company at $200 billion. And if that number does not stop you in your tracks for a moment, then you do not yet fully appreciate what it represents. $200 billion would make Revolut's IPO not just the largest fintech listing in history, but one of the largest public market debuts of any company in any sector anywhere in the world. It would place a company that most people outside of Europe had barely heard of 5 years ago alongside some of the most valuable and recognizable businesses ever created. And it would represent either one of the greatest investment opportunities of the decade or one of the most spectacular examples of peak valuation hubris in a sector that has produced more than its share of both. Understanding which of those two things it actually is requires looking very carefully at what Revolut is, how it got here, and what the path from here to genuine $200 billion value actually looks like in practice. Revolut was founded in London in 2015 with a simple and powerful idea. Take the traditional banking experience, strip out everything that made it slow, expensive, and frustrating, and rebuild it from scratch as a mobile-first product that actually works the way modern consumers want it to. The original product was a prepaid card with no foreign exchange fees, targeted at frequent travelers who were tired of being charged absurd currency conversion margins every time they spent money abroad. That initial product found an audience almost immediately, and from that foundation, Revolut began building one of the most ambitious financial services platforms ever constructed by a private company. Today, Revolut offers current accounts, savings products, stock trading, cryptocurrency buying and selling, insurance, business accounts, international money transfers, and a growing range of lending products across dozens of countries and in multiple currencies simultaneously. The breadth of what Revolut has built in less than a decade is genuinely remarkable, and it goes a long way toward explaining how the company arrived at the valuation conversation it is now having with public market investors. But a remarkable product and a $200 billion valuation are two very different things, and the distance between them is where the most important questions about this IPO actually live. To justify a $200 billion market capitalization, Revolut needs to demonstrate not just that it has built something impressive, but that it has built something that can generate the kind of sustained and growing profits that justify placing it in the same category as financial institutions that have spent decades establishing dominant market positions. The comparison that will dominate every analyst report written about this IPO is with traditional banks and with PayPal, the fintech pioneer whose own public market journey offers both inspiration and cautionary lessons for what Revolut is about to attempt. The bull case for Revolut at this valuation rests on several arguments that are each individually compelling. Revolut has over 40 million customers globally and is adding new users at a rate that most traditional banks can only observe with a mixture of admiration and anxiety. Its revenue growth has been extraordinary, moving from a company that was burning cash at an alarming rate to one that has demonstrated it can generate real and growing profits as its customer base matures and begins using more of the premium products that carry higher margins. The global addressable market for the kind of integrated financial services platform Revolut is building is genuinely enormous, measured in the hundreds of billions of dollars annually, and Revolut has shown a consistent ability to expand into new geographies and new product categories in ways that extend its growth runway significantly beyond what any single market or product could support on its own. The bear case is equally serious and deserves honest attention from anyone considering putting money into this IPO. Revolut operates in one of the most heavily regulated industries in the world, and its regulatory journey has not always been smooth. The company spent years navigating a complex and at times contentious path to obtaining full banking licenses in its key markets, and the constraints that come with those licenses are very different from the freedom it enjoyed as a lighter-touch payments business. Competition in the digital banking space has intensified dramatically since Revolut launched, with traditional banks spending billions upgrading their mobile experiences, and a new generation of well-funded challengers competing for the same customers Revolut is trying to retain and monetize. And $200 billion is a valuation that prices in a very optimistic version of a future that has not yet happened. In a market environment where investors have become considerably more demanding about the relationship between valuation and demonstrated profitability than they were during the peak years of the last fintech boom. The question of whether you should invest when this IPO arrives is one that depends entirely on your investment framework, your time horizon, and your honest assessment of risk. IPOs of this scale and ambition carry a specific set of dynamics that every retail investor should understand before participating. The institutions and insiders who have held Revolut equity through its private market journey are selling into this IPO, and the price at which they sell has been carefully constructed to leave enough upside for public market buyers to feel they are getting an opportunity while still delivering the returns that private investors require. That construction is a negotiation, and the result of that negotiation is not always priced in the public investor's favor. What is certain is that Revolut's IPO will be one of the most significant financial events of the year, and regardless of whether you invest directly, the ripple effects of how it is received by public markets will tell the entire fintech industry something important about where investor appetite for growth-stage financial technology businesses currently stands and where it is likely to go from here.